formal, informal financial system, advantages and disadvantages, how we can define efficient financial system, what are the characteristics. So that part we have covered. Then how we can classify financial system based on the core theme or core domination. We talked about bank based financial system and market based, and then we have seen how in different countries, based on these type of financial system, progress happens. Certain disadvantage, and we also talked about advantages. And we have also discussed what kind of financial system we have in India. And more or less, we all agree that before, 2000 or around late 90s, majority of financial system was driven by banks. And now, we have made a transition from pure bank-based financial system to somewhat market-based. But still, role of banks are quite critical in India. The reason is very clear. When we are going to talk about debt market, equity market is good. Companies can go raise capital very easily. But when it comes to debt market in India, debt market is still in very initial stage. We have not reached to maturity level where all company can come forward and issue the bond or debenture for raising debt capital. So we will talk about in subsequent discussion slides. So this is what Indian financial. So more or less there are some changes, but whether it is we are talking about Indian financial system or we are talking about Canadian, US or European, more or less you will find this kind of structure. And here we are less worried about this part because informal sector we can't do much. The only thing we should know how informal sector can help individuals or small business groups in certain ways. But our major focus would be on formal sector. Why formal sector? Because this is well organized, and when we compare contribution of informal versus formal financial system, formal financial system contribution in any given economy is larger because it is stable, it is more transparent, and people do want to trade or interact in a system where there are fixed guidelines and that are followed. And that's why role of formal financial system is very important whenever we talked about modern or fast growing economies. And many times you may come across, we generally say that in US, because laws and guidelines are very strict, and that's why whether it's domestic investor or it is foreign investor, they do invest in US because up to large extent they are sure that whether it's SEC, Security Exchange Commission of US or other Federal Reserve, or like in India we have RBI. So in US we call it Federal Reserve. So their guidelines ensures that investors are not going to be mistreated, and transparency level is very high. And that's why transparency is one of the factors that ensures the efficiency of any financial system. And yes, yesterday we have also talked about transparency and up to large extent efficiency, various characteristic of efficient financial system. Now coming back to our discussion on financial system, as we know, financial system requires certain regulatory body. It requires intermediaries, because without intermediaries we can't do anything, because all the transactions, all the flow of money, which is the main aim of financial system, will take place through certain channels or through some intermediaries. And that's why intermediaries play very critical role. And how intermediary can play a role? They can only play a role when there is some instrument, because without that nobody will trade. Because if one person is giving certain their savings to a company, in return he will also expect, here if individual is there, individual is, and here you have a corporation, let's say business firm is there. If he is giving money through bank, let's say here you have a bank, so through this intermediary, if bank is extending loan, so this bank is giving loan to this company, and this person has certain savings in the bank. So I saving is going to be lent to a company or to a business entity. So if we eliminate this, what we see that this kind of link is there. And same way, unless there is no incentive for investor, he won't do that. And if we remove this part, if let's say investor having choice of buying share directly, so he will only buy. By buying share means we are eliminating role of a bank. So if that is the case, he is buying share, means he is giving his money. Alternatively, he could have saved or deposited in the bank. So if he is giving money, so of course he will expect share or some kind of equity from the bank, means from the business entity. So unless this share exists as an instrument, this corporation or this company cannot issue it, because in return this is a kind of buy and sell activity. So unless you get something from the borrower is basically this company, you won't do it. It means any financial system will be effective if there are several choices of financial instruments. And reason is very clear, because as an individual, as an investor, our requirement are very different. Some of us may want to take higher risk, some of us prefer less risk, and at the same time your future requirements are going to be different. I may need money after 10 years, but somebody may need money after 5 years. It means maturity, type of instrument, type of riskiness, and then type of instrument. Why? Because instrument could be debt instrument, instrument could be equity type. So I'll also spend some time before I switch from this topic to another topic. I will also talk about instruments, so that those who are not clear with type of instrument, at least they will try to understand it in a better way. So this is the third pillar of financial system, is type of instrument, and at the same time type of services. If you remember yesterday I talked about leasing. Why leasing? Because if we assume that one corporation exists, and this corporation require, we are talking about financial services, this corporation requires certain kind of capital. So let's say big dollar amount of capital required for investing in some way. So one option is company can go to the bank. So this is option number one. So we will first talk about what option this company can try. Second option, what company can do? Company go in the market, issue IPO, or issue equity share, EQ. Third option, company can go to the market and issue debenture or bond, so debt instrument. Or alternatively, what company can do? Company can, because ultimately company is going to use capital, this capital through any of these channels to buy certain machinery. That's what we are assuming, so that our discussion is going to be easy. And if that is the case, third option is company can go and take help of leasing company. So leasing company help can take it. Means rather than using these three channels, company can directly go this channel. So what will happen? A leasing company will buy asset, and ownership will with the type based on type of leasing agreement between company and leasing company. Asset belongs to leasing company, and this firm, B firm, will be able to utilize that asset. And it will only happen if we have this kind of leasing or hire purchase kind of setup. And that's why, because many times company don't want to get into taking long-term loan, issuing share, or issuing debt instrument. So in that way, this kind of services are really going to help company. And that's why these services are an integral part of financial system. So now, is there any question up to this part, initial part? Now, coming back to financial institutions, we will be talking about all these items: banks, non-banking. I assume that most of us know what is banking system, because in banking system you have private banks, foreign banks, regional banks, rural banks. So all these banks are basically scheduled commercial bank. And also we have cooperative banks. If you search, we have almost, I think, 3,200 or so odd cooperative banks, because these are basically, some kind of small, we in US, we call cooperative bank as, credit union. Means, union of certain individuals who, come together for having some kind of credit facility. In India, we call it cooperative bank. In US, Canada, and Europe as well, the term is used as credit union. And when we talk about non-banking, institution, you all know what are the NBFCs, mutual fund, insurance companies. These are basically, companies. And SIDBI, these are basically the institution, development institution that function with a non-banking financial services, and they help in various ways. So we will be also talking about these institutions. And when it comes to other mutual fund houses and insurance companies that are also part of financial intermediaries, we will be talking about. So this is based on structure. So what we are seeing here, this entire part is based on structure or based on type of intermediary. Now we can also classify financial system based on asset or based on market. So here, if you see, this is one side of market classification. Another side of this is financial institution we talked about. Another part of financial system is financial market, because here we covered regulatory part, here we covered institution, here we have instrument, services, and then this is because instrument will be traded somewhere. And where it will be traded, it is going to be traded in financial markets. So we can classify financial market into two categories. One is capital market. So basically when we say capital market, this is long term, means all those instruments which are traded in capital market are long term. Whereas when we talk about money market, this is short term. Generally you will find less than a year. So it means when company require, or like government, many times you will find government also go for raising capital because of certain deficit. So two market exist, either based on long-term requirement. Let's say a company wants to go and issue bond, or issue debt instrument, or debenture we call it. If company wants to raise, one option, either company can contact bank, take 10-15 years, whatever term period company wants to decide, but company can go and take bank loan. Alternatively, company can issue debt instrument, or debenture, we can also call debenture. And again, debenture is going to be a long term. So that's why in capital market, all the instrument that we are going to discuss in subsequent session, they will have a long term maturity. Like whenever we talk about is share, you may be holding share for 2 months or so. For you, your holding period may be short, but by definition itself, share or equity instrument having a long term, or having a long maturity life. And reason is very clear, because you might be holding for a month and then you are selling to another person. So once equity shares are created by the company by registering through with a particular market, NSE or BSE, and when it is created, this asset is created, or equity shares are created, it is going to be transferred n number of individual, n number of investors. So if you look at the entire life of a share is perpetual. Why perpetual? Because in accounting we say that a company is going to last forever, or company will have a very long life, because company is not going to close their all these operations very quickly. And based on that argument, we say that shares are basically long term in nature. Of course, investor may buy and sell it for shorter duration, but life of equity or debt instrument is long. And debt instrument, because it will be specified whether it is a maturity period of 10-year, 20-year, or 25-year, it will be mentioned. But all these instruments where we will classify them as instrument of capital market. Same way, treasury bill, we will talk about all these instruments when we discuss about money market. Treasury bill, call money, these are basically instrument of short term or money market. It means when it is issued with an objective that issuing company required capital for less than a year. And that's why these kind of instruments are issued. Is there any question? So now we talked about major pillar of financial system. We talked about regulatory part, institutions or intermediaries, financial market, financial services. So these are 5 major parts. And our entire discussion in this semester is going to be around these 5 pillars. We will try to explore all these in detail up to some extent, but because of restriction of time, we may not explore in very deep. So you will have, at the end of semester, you will have a fair idea about what is financial system, what are the markets, what are various instruments, so that in the next course, if you take in finance or related domain, you will have a fair idea in what domain you want to get your expertise. You may be more interested in mutual fund, you may be more interested in derivative market, or more interested in equity market. So based on your understanding in this course, you will be able to take it forward. Now,
Sir,
yeah,
sir, futures have an expiration date, right?
yeah, futures. You're talking about future option derivative market?
Yes, yes, sir.
Yeah, we will talk about when we, yes, expiration date here. Even,
Sir,
even, even, if you look at, when we talk about option, we have American and European, and that also, differentiate. You just type, you just search. So for time being, I won't get into detail so that everyone will have at, same level. So, you can when you for expiration date, you can search American option and European option. So you will have more clarity on that.
okay, sir, I was just asking because they fall under capital market, so these are supposed to be long-term maturity. Uh,
Yeah, because you can roll it. If you remember, you can extend it.
okay,
If, yeah, so you look at the characteristic, because if you can roll it forward, you can change your position before exercising it. If that option exists, and that's why this
it
is a
becomes
part of market here.
right.
And another reason, derivatives are basically product of something. That's why something I'm saying because of certain reason. Let's say equity derivative I'm talking about, it is part of equity. If equity is part of capital market, of course derivative will be part of capital market, because you can buy and sell on NSE or BSE or other exchanges. And that is the reason it is classified under the equity market or capital market, I would say.
Okay,
Got it?
sir.
Yeah.
Yes.
So we will discuss. Don't worry, we will discuss, because I'm trying my level best to keep everyone together, so that those who have not very fair idea, at least they should not miss our discussion. And in equity market, two types of market exist: primary and secondary. In primary market, when company is going first time, so company will be going into primary market. If you remember our first slide where we talk about IPO, so IPO will go in primary market, and once IPO is introduced on NSE or BSE, then you can buy and sell in secondary market. So this is how differentiation exists. And also, derivative market is also part, because derivatives are derived product of existing asset class. So that's why, don't worry about, these details. We will talk about later, but you just know that derivative is a kind of product. For example, let's say if equity share is there, share is being traded of a particular company, that share is basically asset, and you create another asset based on the price of that stock, or fundamental of those stock. So that product will become a derivative product of equity. So like, so we will see various instruments that are that exist in derivative market. But this is how, broad classification you should know. And then also same way in primary market, primary segment and secondary segment. So we will talk about in detail more about this. And as I said, that financial instrument can also be classified based on maturity, short term, based on term, and whether it is in primary, these are primary security or secondary security. So this is another classification we have. So this is what in entire semester, this is what we will be talking about. And we'll see how far we can discuss each topic, but I'll try my level best to cover as much as possible, considering the time constraint. And this part I won't be talking about because this is informal and we are not very much worried about that, but our focus would be about the on this formal financial system, because it helps in economy in certain ways. So already we have discussed first slide, if you remember in first slide what financial system is doing. Company requires capital, so company can issue equity. If issuing equity, it means there is requirement of someone, and that someone is nothing but intermediary. So underwriter or intermediary, you can call intermediary is going to help company. So in issuing, it will be helping, and at the same time fund is going to be transferred here. So here we can see the role of intermediary who is in between is very critical. So this is what happens in primary market. And secondary market, who is the intermediary? Basically your NSE or BSE. Of course, there are many, NSE or BSE, basically your exchange. And with exchange, there are various institutions. We will talk about, depository institution, NSDL, CDSL, and then you have various institutions like ICICI Direct, HDFC Securities. So all these together have, are part of financial market and its intermediary. So they help. Let's say here you are investor, and you have account in ICICI Direct, and this ICICI is working with NSE through CDSL, because ICICI will be connected with CDSL, which is part of NSE, and then through you are submitting your order using your demat account with the ICICI, and then it will go to the exchange. So through NSE it will go to the exchange, and then you are going to buy this share of this company. So money will be adjusted in your account, and with following the settlement period, T+2 settlement period, or whatever settlement period is there, you will be getting share of this company. So it will be added to your portfolio. So this is how it happens. It means role of exchange, role of all these intermediaries here is very critical. So in previous case, when company is going to raise capital first time, you need this kind of setup. We are calling it as primary market. And in second case, when shares are already introduced, how financial system can help investor to buy and sell securities. So this is how we have seen that once first time introduction and then subsequent trading, how it can take place in a given market. So you can easily understand role of all these institutions involved in primary and secondary market is very important. And same way, when we talk about global part, because in global, let's say you have one investor in USA, and this investor having n number of options to invest. Generally, there is a term we call it foreign portfolio investment, FPI. In FPI means your foreign portfolio, any investor in another country can directly invest in equity market or in debt market. So that kind of investment we call it FPI. And there is another term we call it FDI. Can anybody tell what is FDI?
Foreign direct investment.
Yes. So how FDI is, can you classify, characterize FDI? What would be the features? Yeah, anyone?
Is it directly investing in an asset abroad, or like?
Anybody else? You are correct. but can you further define? See, when we talk about FDI is foreign direct investment. It directly goes into creating asset. Means like you have already said that assets are some physical infrastructure, physical resources are going to be created. It means FDI having long period of investment. When FDI comes, we assume that it is going to be invested in a country for long term. Whereas when we talk about FPI, foreign portfolio investment, because this is direct investment in capital market or certain securities traded in capital market. It means FPI, these investors, if they feel any risk in a country, they will definitely pull their money back. And that's why you may have come across various news or articles where you will find sudden drop in a particular exchange on a given day, and news will come that foreign investor pulled their money back. So how they are pulling back? They are taking back their foreign portfolio investment. They start selling their investment, and then what happens if panic selling happens? If supply is more, there is no person available other side, market will definitely go down, or there will be a crash situation. And that's why role of these institutions, these foreign institutions, are very important. So in this case, when we are saying FI, you keep FPI as in your mind, that how foreign institutions, they put their money or they invest their money in in another country through intermediaries. Intermediary means again broker, and then there will be other institution, they will be helping. So what is happening here, you can see. So here FII will provide their capital, so capital will go, and then in return they will get some kind of instrument. It is exactly same the way we have seen in previous this slide. The only difference here is there is international flow of capital. Earlier it was Indian investor, they are buying IPO, or they are in buying share of a particular company. In this case, foreign investor is buying certain asset through foreign channel. And that's why it is very critical, because in India, let's say in India we have investor who having only option to invest within the country, but these foreign institutions will have n number of countries where they can invest. So chances are very likely that if country's economy is not doing well, they will pull their money back. If they are pulling, again there will be a pressure in a given exchange or in a market, and then they will invest in some other countries. And that's why if you go and look at government RBI database, you will find that lots of effort is put to ensure that people outside the country, they see India as an investment option. Because if they start pulling money back, then there will be a serious problem. Because it is many times it happens, there is no fundamental problem with the company, but because of some unwanted or because of certain noise, people started in start selling assets. And when they start selling asset, even having a good fundamental of the particular company, those stock prices comes down. So these are certain things which are can be easily explained by behavioral part rather than a rational part. So now coming back to functions. So already more or less we have covered directly, indirectly all these functions. So one major function of financial system is saving function. So can anybody explain what is saving function, or what we are referring, saying that a saving function is an important part of financial system? Can anybody explain what is saving function? Don't Google it, whatever you understood. Based on that, I would like to know your response.
Basically, either like keeping some of your money aside, so investing the money in either like putting it in a deposit or
Right, good. So what we are saying that, let's say if financial system is effective, let's say talking about bank. If bank is transparent, bank follows certain guidelines, and people having trust, what they will do, they don't mind saving their money, right? So if it means, if financial system is effective, it will attract, or it will give incentive for individuals to increase their savings. But there are certain what you call thin line between saving and non-saving. So we will talk about when we discuss about interest rate. But for time being, let's assume that financial system encourages individuals to start saving, because unless they save, pool cannot be this pool cannot be created, and bank won't be able to lend money to the companies. So here corporation won't get money unless there is a saving in the bank. So that's why the saving function is one of the important function of a financial system. Now coming back to liquidity function. Again, when we say liquidity, what we are saying, basically we are saying that there is easiness in various activity, because easiness in terms of borrowing and lending activity, easiness in terms of selling and you know uh, selling and buying asset. So that's why liquidity is another function. So let's say first we take bank example. And when we say liquidity in a bank, we say that because in bank there will be borrower. So here when we talk about bank, in bank there will be several person. You will have corporation, you will have individual, and you will have interbank transaction. So IB, I'll write interbank. It means company may require some kind of amount, an individual who deposited, because here if one individual has, let's say I1 has deposited certain amount, and another individual who earlier deposited, he may also need money, because let's say he I2 deposited some amount 5 years back and it is maturing. It means bank should have enough reserve, enough capital to serve this person. At the same time, if corporation is coming and requesting for a long-term loan, bank should have enough capital to fulfill corporation's requirement. At the same time, when there are interbank lending and borrowing, bank should have enough money or enough liquidity or cash to ensure that interbank borrowing, whatever liabilities are created or liabilities are there, they are able to meet. And apart from that, if you look at various rates, SLR, CRR, so these are regulatory requirements. So this is regulatory requirement, RG. So bank should also fulfill regulatory requirement. It means bank should have enough cash to serve all those. because if not able to serve all those, it means there is no liquidity. So this is one example of liquidity function. And let's say we take another example of, let's say, NSE and BSC. So let's say in NSE there will be, n number of investor, I1 to IN, and these investors, let's say these are from buy side. Same way, you have n number of investor. Let's say I'll say I prime 1 up to I prime M. Means why I'm writing M and N, so that we can differentiate at sell side. This is selling side. So these people want to sell, is equity stock, and these people want to buy. So you assume a case where there is a huge gap between buyer and seller, or volume. So here you can say this gap could have two way. One is in terms of number of buyer and seller, we can call in terms of participation, and in terms of volume. Volume means, let's say buyer want to buy let's say 10,000 shares, and in this side you have only 2,000. It means the gap is very large. Or in this side, number of buyers are, let's say, 1,000 buyers are there, but only 20 seller exist. So it means in terms of participation, this exchange is not doing well. And because of that, there is a huge gap between amount of share that investor wants to buy and amount of share investor wants to sell. So it means unless we have some kind of balance between buyer and seller, participation at the same time in terms of quantity, buyer want to buy and seller want to sell, unless that is happening, liquidity function of exchange cannot take place. Because as I said, liquidity is easiness to buy and sell. Because if this situation exists, let's say any point of time, assuming that this situation is there around 9:30 a.m. So this is not a good situation, because people want, standing buyer are going to stand long in the market to get 10,000 shares, because only 2,000 are available, and 8,000 they will have to wait. So that's why we call it, there is a problem of liquidity in exchange, and that is not good. And that's why this is the important role of regulatory institution and overall financial system to ensure that there is enough liquidity. Same way, payment system, you can think about,
Excuse me, sir.
Yeah.
So in the liquidity function, then why the forex market is we tell highly liquid? That could be also in case be like a case in stock market.
Yes,
Liquid.
see, forex market is 24/7. I believe you are aware. Forex market is 24/7, and you think about whenever you travel. Let's say you are traveling from India to US, you will be converting your in INR into USD. And how you are going to convert? You are going to convert through a bank. Generally, any bank which is available. Either you prefer to do it in India before leaving, or at respective airport. You can show your passport, looking at your stamped visa. You can convert it. So because this is 24/7 exchange, and there is huge demand for conversion. Not only this, you think about import and export, which is happening every day. Many people are buying and selling things across borders, and that is the reason why forex market is very active in terms of volume, in terms of participation, because this is a kind of global market. It is not restricted to India or some other country, and that's why it is liquid market. Because of participation, if you think about, if you have a large number of participants in a given market, it is going to be liquid, because of course your price may not match. Because for example, let's say you want to sell your a dollar at 75 rupee. Hypothetical case I'm talking about, it is not the practical one, because in practical one it happens through the international banks. And there is another party, you want to buy a dollar at 75, another party want to sell at 78. But over the period, if a party which is selling at 78 realize that 78 is very high, nobody will come forward and buy, then there will be a modification. He will be forced to change his course. If any is changing, probably after some time you will find you as a buyer and the seller at the other side will arrive at some value which is a bargainable. So we will both will transact. So this is how liquidity is important function. Yeah. Whether you got answer for your question?
Yes, sir. Yes.
Yeah, so that's why forex market is very dynamic. It is 24/7. It is always open, and that's why liquidity is relatively high as compared to equity or debt market. And function, payment function. As I said that many times we go for online transaction. We make we approach to the bank for taking money bank, or we also sell our holdings or shares, and then we realize money in your respective bank account. So payment system, unless payment system is foolproof, uh, you know uh, foolproof, any financial system cannot achieve the high level of efficiency. Then another function is a risk function. Whenever you are buying a mutual fund, when you are buying insurance, when you are buying any type of instrument that exists in a given economy, risk is involved. And any investor would prefer to buy those instruments when and only when there is he is up to some extent sure that he will be compensated for his or her risk. Like unless you have a strict guideline by SEBI, unless you have strict guidelines by RBI or other regulatory body, that ensures a level of transparency, that creates a kind of trust in individual. And that's why risk is going to be up to large extent compensated by trust, by some kind of guideline. And that's why risk function is one of the important function of financial system. And also whenever we are going to talk about derivative, or when we will talk about hedge fund, we will see that instrument exists that can reduce your risk. You can transfer your risk, or you can share your risk with others. So overall risk is going to be minimum, or will be less for an individual investor. So that's why risk function is another important function. And credit function, when we say credit, you can think about using your credit card, availing capital on credit basis. Because unless this credit function is not effective in a given financial system, nobody would go and transact. And nowadays whatever we buy, more or less it is based on credit function. Whether it's we are buying a car, what we do, we go, we finance it, we get involved in various kind of agreement with the financing company, and then we buy that particular car or we buy a particular asset. And that is happening because credit functioning of financial system is good. They look at your credit history. So because credit function does not limit to one particular transaction, because there is various, like when we talk about credit function, it is your credit rating agencies are there, your individual credit score, how you are in transacting with the bank. So it is closed loop or closed form of structure. So that's why credit is another important function of financial system, because it ensures that right person should not suffer and he or she should get credit facility whenever is required. So these are the four function, and already in term for all this composition of financial market we discussed in previous slide. So I think with this I'll stop my discussion for today, and if you have any question I'll take it. Do you have any question, everyone?
So can you please explain what is a CDSL?
Yes. Credit default swap we're talking about. CDSL, right?
Yes, sir.
This is CDSL. Actually, this is Central Depository Security Limited. This is a full form, I believe. This is the full form. This function, this is a depository institution of exchange, and with this, all these transaction, all these buying and selling activity happens. So this is basically, for time being, you assume that this is intermediary that functions with exchange, and with this intermediary, all these SBI Direct, all these brokerage or brokering firms are connected, and through that we can buy and sell particular asset traded in a given exchange. So when we are going to talk about market, especially secondary market, I'll be discussing about NSDL. NSDL function with the NSC, and CDSL function with BSC. So I think, yeah, in one of the discussion I said CDSL, I believe function with NSC. No, NSDL function with NSC, and CDSL function with BSC, Bombay Stock Exchange. So these are intermediate. We will talk about, don't worry, but assume that these are intermediary just before exchange, and these intermediary are connected with the brokerage firm like ICICI Direct and SBI Security, and with these brokerage firm you are connected, because when you are buying and selling you will be trading with these intermediary. So we will talk about in about these intermediary when we talk about capital market, right?
Okay, sir. Got it.
Yeah. So don't worry. We will be talking about more in detail in subsequent session. And if you have any other question related to what we just discussed, I'll take it. Otherwise, we will close our today's session. Everyone is fine with today's discussion? Fine. Okay, then I'm closing. So we will meet next week, and I'll also reschedule. Reschedule means I'll again in my calendar I'll see why I was not able to join in today's session. Yeah. Thank you.